Welcome back, traders. It's John. It's time for the general market update. It's July 28th, 2023. I'm recording this Friday at approximately 11:20 a.m. The markets are generally almost flat for the week. Reminder, this is a presentation by Rain King LLC, and I'm an amateur individual growth stock investor. Here's our agenda. We're going to put the bull leg of this NASDAQ move in context. We're going to look at some breadth and also a little bit on sentiment, take our first look at some of the earnings reactions we're getting. Then we're going to look back at the action of our leaders. We want to know what's happening. Then we'll summarize, and then I'll talk about a Boston meetup opportunity. So this is the NASDAQ on a weekly chart. We are approximately in week 11 here. Since the breakout that we got to start this bullish leg, you can see here, this is week 11. And we want to look at this thing a little closer in terms of some other bear markets. So the question is, we look at what happened in 2009 and 2003. So at the 12-week mark from a breakout, after a retest, you can see here's week 12 in 09. And it actually resulted in we had a pullback of about 8.2% in 4 weeks. And in 2003, another long drawn out bear market. In week 12, we had reached a point where we just had a pullback start that was a 7.6% pullback, again, over 4 weeks. So as they say, it might be time. We're seeing a little bit of stalling action in the indices, and maybe a well-deserved rest is in order here. So again, when I talk about the broadening of the rally, these are different ETFs, the S&P, have different market capitalizations. Now, what I wanted to show was the IWP is Russell Large Cap Growth Stocks. You can see they broke out first, and they were running. They've been running for 6, 7, or 8 weeks. Now, if we step down to the mid-cap level, the IWP, this should have been, I think, IWF. IWP, you'll see that they've broken out, but they're still fresh in terms they've only been moving for 2, 3 weeks. Now, if we step down another capitalization to the Russell 2000 Small Cap Growth, the IWO, you can see we're just trying to break out. So, it's still good progression. We're seeing these constructive charts trying to move higher. So it's trying to emphasize that there is broadening by market cap. This is the NASDAQ daily chart. I cut this chart about 15 minutes ago. You can see the market is not moving that much today. But the more important is, we had this wild, sloppy day yesterday, and which was the result of this little 4-day rally attempt. And it's been a pretty weak rally, and it reversed pretty hard. And some of the leading stocks got hit. Some of these leading stocks, they could not push. They didn't have enough push to get to new highs, with a few exceptions. But even the earnings of Meta, which were strong and a gap up, were sold into. So it just says that maybe we need more time for the market to digest this, particularly as we looked at those weekly charts. And it seems to be about the time that we might be due for a pause and pullback. A pullback to the 50-day is marked here. It'd be about 5.5%. It'd be completely normal, and it would be actually healthy to help set us up for the next bull leg. The other thing that's constructive is you'll notice this is net new highs, new lows on the NASDAQ. We've maintained net new highs even on these small dips in the market. So that's another feather in the market's cap. So let's delve into the breadth. This is the S&P 500 stocks, that the percent that is above the 200-day moving average. Now, you'll notice that we're up to about the 75% level, which is really good. It's really healthy, because generally above 70% is associated with typical bull markets. Now, the peak we had in January actually reached 79%. So we're making an assault on setting a new high here, which is all really constructive. Now, I pulled up a number of economically sensitive sectors and ETFs, again, to speak to the broadening and breadth of the market. This is PAVE, which is an ETF, which is about infrastructure. It's a lot about construction, concrete aggregates, stone, equipment stocks. And you can see it broke out 4 or 5 weeks ago and is moving up nicely. Steel also formed a base, is starting to move. And copper, the copper miners have been in a consolidation for many, many months, and they look like they're perched to try and break out. Copper is very economically sensitive worldwide. And even the oil and energy sectors have been doing well. This is the Oil Services ETF, OIH, and you can see the base that it's formed, and it looks like it's going to make an attempt at a breakout. So again, economically sensitive sectors showing strength, and all of these are above relative strength of 80, many above 85, is really playing into maybe the soft landing scenario for the economy. So let's move to sentiment. This is the American Association of Individual Investors survey as of last week. And you'll notice that the green is bullish. You see we now have 51.4% bulls, which is quite a jump from where we were a couple of weeks ago when we had 41% bulls. So we'll come back to this in a moment, but I wanted to overlay this with a chart from Carson Research. They've shown that when we get the S&P, we look at the S&P after the AAI survey, when the bulls exceed 50%, what does the S&P do going forward? And they've marked this signal in these little green dots on the chart, and you can see many of them are coming out of bear markets. So what they're saying is that just because we have sentiment kind of spike higher, is not always a bad thing. When we're early in a bull trend. And you can see here's the 1 month, 3 month, 6 month, and 12-month returns for when the signal is hit and what the S&P did looking forward. They're all pretty constructive. Now, in the short term, this push of almost 10% in sentiment is likely due to the late FOMO buying by the investing public, individual investors. People are finally becoming convinced that maybe they're missing the rally. They're buying stocks that, frankly, are probably extended. That might not end so well. But it's important just to keep tabs on this. Now, this is a sentiment indicator, and we want to emphasize that sentiment indicators are completely secondary. And I believe it was Bill O'Neill in his book said that the early stages of a new bull market, sentiment indicators and overbought readings, et cetera, can be very, very unreliable. So we don't want to put too much weight into this. What we're really looking for is the price and the volume and the breadth of the market, which continue to be strong. So this is from macro charts. Again, this is looking at complete options flow, and they look at extremes in this particular chart. They have an extreme line shown at the top, and they have panic and capitulation at the bottom when everybody is buying puts. So you can see here we've exceeded the upside for what they consider the FOMO or euphoria, where traders are buying many, many, many calls trying to chase this rally late. And you've noticed that it's starting to turn back down, which the S&P 500 is overlaid here. So again, this is just kind of reinforcing that perhaps the AAI survey is reinforced by a lot of call buying done, perhaps late. Now, here's a look that gives us some insight into the institutional appetite for risk. This is the Bank of America Global Fund Manager Survey. And one of the questions in that survey was, what level of risk do you think you're currently taking in your investments? And they're trying to map out the net percent taking higher than normal risks. So usually in a bull market, late in a bull market, people take more risks. So you can see here in 2020 and 2021, investment managers' percentage was pretty high, that they were taking more than their normal risks. You can see here that with the bear market, we're way, way down low. We're back down to the 2009 levels, where investment managers are taking way less risk than normal. Now, as things change, the market rally broadens, and their desire to keep up with their benchmarks, we could see, more institutional money take on risk as we go forward. So I wanted to share a little blurb on a couple of psychological numbers and valuations. I'm going to do a GMU extra, particularly on this topic, but I thought it would be timely to share an observation. Now, with psychological numbers, what we want to look at, a couple of levels that are important are the 100 level and the 500 level. And I want to use NVIDIA here in a current chart. Now, NVIDIA broke out of a little cup base late last year, and the base was around 188. And we've made over a 100% move in NVIDIA without very little pause, no other bases, no real consolidations. So, and we are approaching the 500 psychological level. And when you get, if you look at market history and the topping process of stocks and where they pause, you will see that when you have 100% move or more, and you're going into a psychological level like 500, there's a couple things that might happen. You might get a pause. And you'll notice that as NVIDIA has reached the 460, 470, 480, we're starting to get some stalling signs here. So we might pause for a little while. Many times, if a run has been going on for 12 to 18 months and this happens, you might get a top. Now, that's not the case with NVIDIA's context. Or we might need to form a full base. We might see NVIDIA consolidate and form a 5, 6, 7-week base, maybe just below the 500 level before possibly moving higher. But it's something to be aware of. I know over history looking at this, 100% move into a psychological level can definitely be a pause. Now, I've also shown Apple on the right. Again, current chart, and this is using the $3 trillion valuation, which corresponds to about 194 on Apple's chart. Now, in November of 2021, when we topped out, Apple pretty much topped out going into the 3 trillion valuation, topped out around 183. And it backed off, and then we went into the bear market. So it's definitely a level of, again, these psychological levels can be either support or resistance. So you see this pretty much unfettered move in Apple in 2023 has started to chop around a little bit and starting to pause. We're up in the 193 area, which is right around that 3 trillion valuations that institutions are looking at. They're saying, do we believe Apple is worth 3 trillion or more, or is it worth less? So it's possible, again, that Apple might pause here, chop around, given some of the action in the NASDAQ. I wouldn't be surprised to see some consolidation. So earnings reactions. So far, we've seen a handful of reactions, mostly large cap stocks. Tesla was a gap down, ASML was a gap down, Netflix was a big gap down, Microsoft gap down. It's actually threatening to break the 50-day moving average. What we saw this week, Google actually gapped up, but it's having some weak follow through. Meta gapped up, but it was sold off into. So we had a gap down in CMG, but yesterday we had Lam Research gap up to 52-week new highs, which is really constructive. And Roku has gapped this morning, though it's still in a base. So it's very mixed. It's not great for growth stocks. Now, it's not that surprising because these big 7 stocks have already had some major moves moving the index. Now, in the next 2 weeks, we've got a whole bunch of kind of very key earnings that we want to watch in growth. We got ALGM, Confluent, DevilVerify, and all the rest, including the leader of the market right now, Supermicro. So we want to watch those over the next 2 weeks. And those of you that were participants in our earnings gap workshop event and purchase the additional earnings calls, we're going to be setting up our earnings call August 4th. And we're looking forward to that because we'll give people all the preparation they need to do for these growth stock earnings. Now, let's take a quick look at the action of the leading stocks. As I mentioned a couple of weeks ago, I monitor the leaders by checking distribution day counts in individual stocks, the relative strength line, and the percent off of highs. So I've updated this chart as of last night of some of the leading stocks, and I've sorted this by percent off the 52-week high. You can see here Supermicro is still making new highs, so we go from very the peak, and then you can see Tesla is actually 18.7% off its high, which is more than we'd like to see. I track this because generally, when we talk about stocks that make bases, we want to see ourselves stay within striking distance, which is kind of the 15% or less. When we get into over 15%, we'll probably have to wait for a base that might be 6, 7, 8 weeks or longer. These smaller corrections, we know that flat bases can be 15% or less, or we might get another pattern. But you'll notice if you go back to the other video, we're seeing a little bit more beige and a little bit more red on this chart than we saw 2 weeks ago, and that's kind of consistent with the pause in the market and the potential to pull back. So just some of the action in the leaders, not abnormal at this stage. I also put together a second group in which I call the young guns. And these are more stocks that IPO'd in the last 2 to 3 years and some more recently this year. And same exercise. You can see Airbnb is acting well, no distribution days, just off its 52-week high, strong accumulation rating and good RS line. But you can see some of the others that are struggling. They're still well off their 52-week highs. But again, it's important to keep track of the new merchandise because institutions will be looking at new merchandise to really help us push a bull market further. So let's summarize where we're at. Now, bull markets, we all know that they climb a wall of worry. There's always something to worry about, and there certainly is today. There's talk of inverted yield curves, the hawkish Fed. What will they do in September? There's a recession that somehow is still looming out here at some point. My thoughts are generally the Fed has made the big moves. They've made the big moves going from essentially 0 to over 5%. And now they're essentially fine-tuning the dial. And they're going to be looking and evaluating. There's lag time to get new data to decide if they need to go further. But I think it's all fine-tuning of the dial. I'm not sure it's going to make a huge amount of difference unless something dramatically happens in the world or the economy. Now, earnings reactions, they're mixed to poor so far with growth stocks, but there's a lot more to come. We're early in the earnings season. We have the whole month of August to get some reports, to get the temperature of growth stocks. Now, we started rallying in January. We had a little pause in March, but this next leg got started in May. So if the market is under accumulation by institutions, which it appears to be, this pullback should be fairly muted. It should be somewhere in the 3 to 6% range. And we should just keep that in mind that, the trend and evidence is up until it isn't. So right now, we're still in a bullish uptrend. Now, so far, this little 4-day bounce that we got this week is weak. It's not very good. It's low volume. Leaders couldn't push higher. It probably just means time. We need time for the market to digest, possibly pull back a little bit for a few weeks, but all in a constructive way would help build a launching pad for possibly the next leg. So it's important here to be patient. If you're holding positions with gains, be patient. Now, if you don't own the leaders, look for opportunities to get into those leading stocks as they pull back. So be patient here. It's not a time to chase. Exposure levels, I think, for myself, still remain in the 50 to 75% range. Need to be very incremental here and not add too quickly to stocks. Don't chase any extended stocks and always watch your average cost. So here's the Boston IBD Meetup event that I wanted to make you aware of. In August, we're going to do a meetup, and we're going to call it the Twitter Follower Chart Talk. I'm teaming up with a teammate on Twitter. Many of you might be familiar at TA Plot. He is a growth stock investor, strong proponent of Mark Minervini's VCP's philosophies, and myself. So in order to participate in this meetup, you need to be a follower of both of us. So there's the handles to join. Now, the concept's going to go like this. We're going to have people make a submission to us of 1 to 2 of their trades, showing entries, exits, position size. And what we're going to do is TA and I will provide feedback on what we see in your trade. We'll give you comments on what we see about your stock selection, the setup that you were using, the sizing, the risk management, etc. We think it's a great way to get some feedback from 2 experienced growth investors. So you may want to participate in that. Now, the details of the event date, we're still working that out, but I'll have the date soon, and we'll also give you the process of how do you make a submission of a trade. We won't share any names of people at the meeting, but we will take your chart with your entries and exits and sizing and put it on the screen generically so we can talk about it. So when we make comments, though, if you're on the meeting, you'll hear that we're speaking to you. So probably in about a week, I'll have the details, and it may be something that you want to have an opportunity, pretty much a rare opportunity to get feedback on your trades. So at this point in the market, I pulled a quote from Paul Tudor Jones. I'm always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have. And the point is, defense first. Always have your defense plan in place first. Offense comes second. That's the general market update for July 28th, 2023. Here's where you can find me, and I look forward to seeing everybody next week.